I'm going to tell you 5 things about this inglorious economy as we tilt right into a recession. You need to understand these things because it's more important right now than ever. It's getting very serious now. I'm even going to tell you some of the things that I did myself with my own portfolio. I'll tell you some of the moves I made that you could make too to help make sure you're set up in the right way as we go into this economic chaos. Inglorious economy point number 1. Unemployment is a lagging indicator. You always see these politicians and the powers that be and the Federal Reserve representatives talking about how low the unemployment rate is. And yes, I'll give it credit where it's due. The unemployment rate is incredibly strong right now. There's 1.5 jobs for everybody who is possibly needing a job. There are now a record 5 million more job openings than unemployed people in the United States. That's from CNBC. This is from Yahoo Finance. Workers are getting 2 jobs amid inflation. A lot of them are becoming waitresses on the side. A lot of them are becoming Uber drivers. People are having a harder time making ends meet. And that's why the job market in America is so strong. We just recently got a surprisingly strong jobs report. A lot of people are taking multiple jobs. Part of the problem is efficiencies, where you can make a robot or a machine that can do the job of 10 people. You used to need 100 people working the fields, and now you just need one guy with a tractor. It puts people out of work, for better or worse. For worse for the employees that lose their job, but for better for the employees that hated their job, and for better for overall society. However, all of that can be put aside. All the things that the government tells you, the things the Federal Reserve tells you, all of that can be put aside because none of it matters as soon as we enter recession. They'll say, well, I did promise A, B, and C, but now we're in a recession, so now I got to do these things differently. Opposite to what I told you before. That's exactly how it's going to play out. When we go into a recession, it will be a different economic world than it is every day leading up to that point. And glorious economy point number 2. The American debt bomb is getting visibly exposed for the first time. People have known for a while the problems of the debts, but only now is the mass market starting to recognize the actual results or problems with this setup that we're dealing with. The more you shed light on a problem, the more you notice what the problem actually is, the more likely you are to possibly fix it. I always tell you that the way that this debt bomb explosion is going to begin, it will be manifested first with the pension crisis, retirement crisis. There's going to be calls for extending the retirement age, and they'll say, well, people live longer now, they're healthier now. They're changing the agreement that they made with you in the first place. A lot of retirees are not going to get what they expected to get, and even the ones who get what they were entitled to or what they expected, a lot of times that's with diluted money where they aren't able to buy what they were originally expecting that the retirement would allow them to purchase. Now here's a report I got from McKinsey Financial, and they are trying to get you to buy their products, so do what you will. I don't know if they're any good or what. But it's a 6-page document. The first page is just the cover page, so really 5 pages. But the report is the looming pension crisis, what it is and why it matters. One of the things they say in it is nearly half, or 47% of seniors surveyed, rated the conditions of their retirement savings as poor. And 44% said they had not saved enough to retire comfortably. Additionally, 57% said they were somewhat or not optimistic that the savings would last through retirement. And here's another one. Retirement crisis or not, America needs to reboot their approach. Is there a retirement crisis in the United States? And this is from Yahoo Finance, 10 jaw-dropping stats about the state of retirement in America. This is from Common Dreams. Working longer is not a viable solution to the U.S. retirement crisis, economists say. These are just all showing you that there's finally some light being put on this problem that I've been telling you about for eons. This is from Bloomberg. Retirement savings shortfall. Governments face a $1.3 trillion shortfall. A new analysis states that the federal government will be on the hook for a massive bill as more Americans age out of the workforce. This is from Motley Fool. America is facing a retirement crisis. Here's why. Fox Business. Most seniors say the U.S. is suffering a retirement crisis and many are struggling to save. 89% of seniors say they are worried that the U.S. is in the grip of a retirement crisis. This is from Go Banking Rates. Experts say silent crisis with retirement savings loom worldwide. Still, as I always tell you, keep an eye on this. It actually is going to explode in everyone's faces, just like it did recently in the United Kingdom. And in France, you saw what happened when they tried to raise the retirement age. This is the problem that you cannot sweep under the rug. It'll just be getting more and more significant all the time until it explodes. Inglorious economy, point number 3. People are only now going to start feeling the real weight of the interest rate pain. Here's a chart of the increased interest rates, which took them to a 40-year high in a very short window of time. And I always tell you that the rate effect will always have a delay of many quarters sometimes. But at any rate, the interest rate increases that we first saw are now having their effect. And as they increase rates even more, those will have a delayed effect as well, which will then add on top of the interest rate pain we're already feeling. So how would you expect all this to manifest or play out? What would you think you would see in the economy if this actually was a problem for most people? You start to see delinquencies on auto loans increase. That's one of the first ways that the pain from these interest rate increases are going to play out. So are there increases in auto loan delinquencies? Of course there are, or else I wouldn't be talking about it. But this is from the deep dive. The number of auto loan accounts considered severely delinquent has reached an all-time high in 2023. In a Q1 2023 Industry Insights and Sales Forecast, which is held by Cox Automotive, it was reported that the severe account delinquency rate, non-paying loan accounts that are beyond overdue, has surpassed a record high set in 2009. What else happened in 2009? Well, let's see. That was right on the very tail end, or just after the global financial crisis. So you see, you have the crisis, or the recession, and then there's a delay until you start to see the uptick in auto loan delinquencies, mortgage delinquencies, line of credit delinquencies. But pay attention to this next sentence here. Analysts of the firm also noted that the rate of delinquencies are surpassing the surge of the heating interest rate environment, which was a convoluted way to say something that all they're saying is that the speed at which the delinquencies is increasing is outpacing the speed at which the interest rates are increasing, which is a very bad sign. But what about bankruptcies? That's what else you would say if there's all this pain. Where are the bankruptcies? And there's been many, many of them. I'll talk about a few in a second. But the economy was healthy enough that the bankruptcy rate was very low. So from a very low base, that bankruptcy rate is just beginning to start to increase. This is from S&P Global. U.S. corporate bankruptcy filings hit a 12-year high in the first 2 months of 2023. So what are we dealing with here? In January, there's 54 bankruptcies. In February, there was 57 bankruptcies. And if you look all the way through April, more than 230 American companies have filed for bankruptcy through April of 2023. And since those 230 companies went bankrupt, there's been many, many more. Here's a few examples that they listed in this S&P Global article. Vice Media, Cox Operating, and Envision Healthcare also went bankrupt. I would suggest that you look at the hard truths. Many of these you know to be true. There's so much unpayable debt. And they even have taken to calling it unfunded liabilities because they don't want to have to deal with that. So that's just something else. So put it in a bucket. That's unfunded liabilities, everyone. Now we've got, besides that, we've got this massive debt that is unpayable. And the servicing costs on the federal debt is now many billions of dollars more expensive because of these increased interest rates. Many pensioners are going to be the big losers in this looming pension crisis, which is a matter of time until it explodes. And most mortgage payments are actually double what they used to be, at least double for many of them, not that long ago when they were less than half the price they are now. And the one thing that often gets overlooked is that there is always a recession. There's always a recession inbound. The one that we are due for is, and I don't like to say due for, but the one that we are due for is set up to be a big one and it's going to be here relatively soon. So as promised, you're going to wonder, what do you do next? What do you do about it? This is all good and great talking about all this horrible economic news, but what do you do about it? The best way to explain by telling you what I am doing and what I've done myself and how I'm setting my own portfolio up, Besides that, it'll be most effective if I explain to you what my overall premise is, and you'll understand the moves I'm making underneath the umbrella of that premise. My overall educated and analysis-based opinion is that as we enter this recession, which we will, it could lead to a lot of changes that will have an effect on you and the overall economy as well. As the recession approaches and gets here eventually, businesses will see their revenues starting to decline, and so they'll say, maybe we should put off some of those bigger expenses we had in mind. And they'll do that, and they'll start to try and cut costs. And if that doesn't work, then the next step is always layoffs. You start lowering the headcount of the company. And once we get to that point where unemployment starts rising and has risen 1.5% to 2% from where it is right now, so over 5%, towards 5%, by that point, the number of people who are underwater on their mortgage will have grown significantly, but people will be underwater just by the increased interest rates alone. They have to pay more into their house than the actual value of the house is worth. But we've seen real estate prices in the States start to just crack a little bit, but they're being resilient. They're holding up so far. Not so in Canada here, north of the border. There's a lot of houses now that are listed for half the price that they recently sold or were bought for, or they're just listing it at half the price of what they used to ask for that same house matter a year and a half, 2 years ago. Here's a chart of mortgage rates. This is from Trading Economics. And you can see that mortgage rates have more than doubled over 2022 in a very short window of time. I always tell you, it could double over 4 decades, but if it doubles over a year, that's way too fast. It's hard to adapt to or adjust to the effects of those changes. But these higher interest rates are going to affect all types of debt. Lines of credit, boat loans, your mortgage, your credit cards, or your corporation's operational deficit, anywhere there's liabilities, anywhere that money is being borrowed. It will all cost dramatically more than it did not too long ago. Glorious economy point number 4. Do not confuse the stock market and the economy. They're two different things now. They used to be somewhat related. The detachment has never been more extreme. They're two totally different things. That's why the economy can do what it's doing right now, yet the stock market holds up relatively okay. So what is it that I mean when I say that the economy is doing what it's doing right now? Well, here's just a few examples. World Bank sees major economies growing at a much slower pace thanks to higher rates and banking stress. US, Japan, and the Euro area countries are expected to grow by only 0.7% in 2023, down from 2.6%. It's less than a third of what it was just 1 year earlier. The US is projected to grow at 1.1%, while the Euro area and Japan are projected to see GDP growth of less than 1% in 2023. That's basically anemic growth. That's as little growth as you could get without it being negative. Fed report shows banks worried about the conditions ahead with focus on the slowing economy and deposit outflows. Wholesale prices rose 0.2% in April, less than the estimate as inflation pressures ease. Consumer debt passes $17 trillion for the first time despite the slide in mortgage demand. Retail sales rose 0.4% in April, less than expected. These are just a few examples. I could go on all day with a lot more if you want, but we got to move on. All of these pieces are telling you a story. You can watch all of these things and you can see the actual economy weakening before your very eyes. But don't confuse the economy for the stock market. The stock market could do really well while the economy falls off a cliff, apparently. When will the stock market do well? They'll do well from the point of the Federal Reserve making that pivot point where they say we're not going to raise rates anymore. We're not going to hold rates high anymore. We're going to start lowering rates, which could be as soon as a few months from now, depending how things go. But first, they're going to raise rates one more time. But historically, if you look at when a rate reducing cycle starts till the end of it, which could take a year and a half, 2 years maybe for the whole cycle to run its course, you're going to see high single-digit, very, very low double-digit growth in most stocks. Most stocks will pick up 11%, or most stocks will pick up 8% between when the Fed starts reducing rates to when they stop reducing rates at the end of the cycle. Although I'll say that we have a lot better valuations than previously when I was really worried about it. When I myself took action and got rid of all my blue chip stocks like GameStop, Cracker Barrel, Harley Davidson, all of that stuff, and I moved more into things that I expect to do well going forward, which includes a bunch of stuff I'm going to tell you in this video. Inglorious economy, point number 5. There's been many big name percentage drops in price for a lot of stocks that were heavily overvalued, so that's a good thing. And we've even had some of the early bankruptcies that I'm expecting. These are the earliest ones before it becomes more of a tsunami. And you might say the stocks have been doing okay lately. They've been holding their own. But if you look at the moves in the markets, it's mostly driven by a few big name companies. A lot of these FANG stocks, Apple, Alphabet, they're the ones that are benefiting, while overall most stocks are trading lower. Here are 3-year charts of, first one here is Amazon. And there's the point I always told you about between delusion and reality. And then here's a 3-year chart of GameStop. And we've been dealing with bankruptcies for quite a while now. They're starting to pile up. And you might have even forgot some of the earlier ones that were pretty big name bankruptcies that we witnessed in our lifetimes. Some of these companies that went bankrupt were Neiman Marcus, JCPenney, Sears, which is a huge company in Canada, Toys R Us, and even Circuit City went bankrupt. These are just a few of the examples I'm giving you, but there will be a lot more to come yet. There's a lot of companies that are not bankrupt right now, but 6 months from now, they will be bankrupt. And if you want to look at the industries, how they've performed over all of last year, 2022, while energy was up 59%, communication services were down 40.4%. Consumer discretionary, which is one of the first things to go when the mud starts hitting the fan. You don't buy discretionary items. So that was down 37.6%. Information technology, 28.9%. And actually, if you combine both those together, that's what my company is. Real estate was down 28.4%. Materials and financials also had double-digit declines in price. But that's just a snapshot of 2022. And I'm using it to show you how a lot of these overvalued companies that I'm so worried about have finally started repairing to where they should be trading at, even if that's at zero for some. As you know, I expect inflation to still come down between now and the pivot point that I'm talking about, the big inflationary bounce, which is a video coming out soon that we're working on right now. It's about to be ready probably after this one. But I do believe that all these broad-based economic hardships, while we have them, will be an anti-inflationary force. People will spend less money. People will find ways to not go out to restaurants, not buy that extra thing. They'll give their children less allowance. They will donate to charities less. And by the way, FYI, charities always take a big hit when the economy takes a big hit. That's one of the first places, or one of the first ways that people cut back on spending. They stop giving money to charity. So if you're involved with a charity, you have a charity that you like to support, keep that in mind about when you're going to donate and if you're going to keep donating through the hard times. That's when they need it the most. And all of this entire premise and everything I talked about in these videos is leading up to one very specific pain point. And that will be the exact moment when the government overreacts. They will create an excessive amount of new money. They won't print it. They don't do that anymore where they print these big sheets of dollar bills. They just add a digit. They just go to their keyboard and type it in, and there's $1 trillion. There's $1 billion. That's how insane this has gone. That and the $1 trillion coin. Put those two together, and anybody who doesn't see this coming, it's on you. The result of their actions will be basically another extension of this monetary creation chart. Can you tell me on this chart, where does it get weird? Where does something strange happen? This will just then extend this monetary creation line up on a logarithmic level to a ridiculous and irresponsible degree. I mean, after all, if QE1 and QE2 and QE3 didn't work, and not QE didn't work, and then QE infinity didn't work, I suppose the best idea or the best course of action would to now do the exact same thing one more time. That's what they'll do. And they'll say things that are crazy like they did last time. They'll say the problem was that it wasn't big enough. We needed to create even more money. But I believe that they're going to do QE next, which will be soon. And it'll be an overreaction to the pain point of all people having economic hardships. The tent cities were bigger. The lineups of the food bank are longer. And a lot of their constituents that vote for them will be having hardships and they want to get reelected. So they go, let's do QE next. And you'll get some inflation there, but not hyperinflation. Hyperinflation is 50% more per month. And then when they're done getting all that done and they've realized that that also did not work, that's when they say, well, the problem was that it wasn't big enough, and they come over the top with an even bigger amount. But my point is that they're not ever addressing the problem. The literal problem is the operating deficit of the country. Every month, we're spending more money than we're creating or generating. As long as there's an operating deficit, we will always have debt ceiling debates and crisis coming up in the future. As soon as you operate at a surplus, you create more money than you're spending, then you can start cutting away at the debt and getting back on an economically sound footing. So then they come over with QE last, I'll call it. They go QE next, it didn't work, wasn't big enough. They go QE last, and they just douse the earth with trillions and trillions of dollars, and that's the start of what could be eventually hyperinflation, and that's the start of the big inflationary bounce that I'm saying is coming up. And when we don't make enough to cover our expenses, we have to look to other countries. Usually in the past, we've been looking to other countries like Japan and China to buy some of our debt to help cover. We take that money to help cover our operating deficit. But other countries are not so interested in buying our debt anymore, and a lot of them are selling it. Here's an article from Financial Post. China is quietly trying to dethrone the dollar. You guys know all about that. I don't think it's being that quiet anymore. It used to be quiet. Now it's pretty loud. They're basically saying, here's what we're doing with India, China, Russia, South Africa, and Brazil. They're all getting together and getting a gold-backed currency that they're going to use. And it's not going to supplant the US dollar, but it's going to put a lot of pressure on the usage of the US dollar worldwide. So what do you do about all of this? The good news is that there are things you can do to preserve your wealth, avoid risks, take advantage of opportunities. That's what this channel is about. This channel is about you, your wealth, your opportunities. What moves are you going to make? How are you going to understand the economy? It's about you. Right now, I imagine that you're doing a lot of things to deal with the inflation that we're already seeing before it gets really bad. And you might have done what a lot of people did, and I know I did a lot of this too. You go on your credit card, you start canceling all these recurring billings that you don't even know what half of them do or where they're from or how you got them on your credit card, but you start canceling them, you don't use them. People start cutting expenses back in all sorts of ways, not going out to dinner as much. And yeah, it sucks, but it's a temporary thing. Do things right now and you'll be glad on this side of things. But whatever you're doing right now, because of higher inflation, the ways that you're adapting to it, adjusting to it, do more of that. If you're saving money by going out to dinner less often, then go out to dinner even less often. As the inflation gets worse, you have to adapt to it, more of the same of what you're already doing to deal with the inflation that you're already seeing. And keep in mind that when the Fed pivots, they'll raise rates probably one more quarter point, and then the next one will be a pause, and then one after that will be a decline in the rates. When they start that cycle of decline from the highest point all the way until they're done reducing rates, that will be really good for stocks. It'll be incredibly good for precious metals, commodities like cotton, coffee, and pork bellies. You're going to see pork belly prices spiking. But it'll also be good for anyone who owes money to anyone. And it will also stoke really strong and positive investor optimism, which is one of the things that helps drive stock prices higher when people are irrationally exuberant about the stocks they're going to buy. But of all the good things, when they pivot, there'll be a lot of bad too. Bad thing for the US dollar, it will lose a lot of its value. A lot of times, interest rates are what's holding up a country's currency. In the case of the American dollar, though, that's also a flight to safety, and it's also backed by the strongest economy in the world, so it's a bit different than some endemic currency from Greece or Bolivia. And as I'm going to tell you all the things I'm doing, the choices and decisions I've made for my own personal investments, I'm going to say that you should do whatever you're going to do. You got to make your own decisions and live with the results of those decisions. I'm not telling you what to do. I'm telling you what I'm doing. I expect the US dollar to decline in value a lot. I expect the results of that will be an increase in the price of gold itself. Gold is also nature's insurance and a flight to safety in case a war breaks out, which there are a couple of big ones right now and soon to be bigger. And as a result of the increased gold prices, I believe that the profit margins of the best gold mining companies will absolutely explode. Gold prices could go up 10%, and the profit margins of a company could go up 100% on the same exact move. So I myself have bought a lot of silver mining companies, gold mining companies, and I own a lot of the physical precious metals as well. Get some of those if you want to, because now's the time to do it. Sometimes it's very difficult to get gold or silver when you want it. Silver is a lot easier. Also, what I did is I leaned towards safer, more stable industries, away from this highly speculative stuff. It's not about taking a chance on GameStop and hoping it's going to make you a millionaire. Get into things like casket makers, funeral home companies, rendering plants, boring stuff that just consistently spits out money. Dividend paying utility companies, companies that have the water rates, or a cell phone company that's producing more money every month than they're spending. But also look into, what I've done, I've started buying up a lot of oil companies related to oil prices going a lot higher, because we're getting closer to the end here. I told you guys on the global oil clock that I made, we've got just over 40 years left of oil at the current extraction rates, usage rates. We're going through 85 million barrels of oil a day. And as we approach the time when there's not a lot of oil left, there's going to be a lot of oil-related wars. There's already a bunch setting up right now. There will be more obviously known oil wars. So a lot of dividend-paying oil companies, I think, would be a good way to invest right now, in my opinion. This is not personalized trading advice. What I do, though, is I average up rather than average down. Newer investors will always average down. You bought a stock, you thought it was going to go up. It's going to go in the exact opposite way that you thought. So you put more money into it to lower your overall average cost. A lot of times, that stock will keep on doing exactly the opposite of what you thought it was going to do. And sometimes you'll average in again and again. I knew a guy who worked for Nortel, and he averaged down all the way down to zero, and he lost everything. But a more experienced investor is going to average up. If I buy a stock and I think it's going to go up in price and it goes up 10, 20%, I'm saying, okay, now it's actually doing what I thought it was going to do, and everything else is falling into place, then you put more money into that stock. It's doing what you thought it would do, so it's likely that it'll keep on doing what you thought it was going to do. And keep some cash at home, put it in a book, put the book back on your shelf, and forget about it. $200, 10s and 20s, that's it. And just put it away, you're not going to miss it. Just forget about it completely. At a time of utmost need, you're going to remember it's there. There might be a time where you're going to need cash. Sometimes bank machines shut down. You never know what's going to happen, but it'll never hurt you to have a few $100 in a book on your shelf and just leave it there. And take a full situational survey or audit. How much money do you make? What are your expenses? How secure is your job if there's a significant recession? What's the plan if you lost your job? If your job's secure and the world goes through a big recession, what's your plan at that point, even if you keep your job? And I would say about dependents, you probably have parents who are getting older, up there in years, and maybe they're some of the people who are going to get hurt by this retirement crisis or this pension crisis, and all of a sudden they will become a dependent for you. And I'll tell you about the time I traded, literally, and this truly happened, candles for chicken. I had a bunch of dehydrated food. I had a radio that you crank by hand to, it doesn't need batteries, so you can listen to the radio if the world explodes. I had a flashlight that you crank so it doesn't need a battery. I had all these candles, and supplies, water, etc. I wasn't a prepper. I wasn't a survivalist. I just thought it would be a good idea to have everything in the house in case who knows what happened. You had to stay in the house for a month. But I had all these candles, excessive amounts of candles. And I would say to my ex-wife, well, you can trade them for things like chicken. And she's like thinking I'm crazy, right? And so I'm driving home with all these candles stacked up in the back seat of my car. And I see my neighbor and friend who's at his chicken restaurant. And I pull over and he's asking me why I got all these candles in the back of the car. I said, I'm going to trade them for things when the world falls off a cliff. And we got to talking, and eventually I got a chicken dinner for a flat of some of those candles. So everything I was preparing for was all starting to play out.